Ladies and gentlemen, welcome to the Unnamed Podcast here with the great and powerful Brad Freeman and the just as great and just as amazing Evan Stock Market Nerd, or Stock Market News. Getting these guys' names mixed up. It's too similar.
I will say, I've heard you say powerful every single time. So the fact that I got a different adjective makes me feel extra special. So we're good with the mess up.
I always say great and powerful. I have to create something else for you.
Evan, we need to get you that Stock Market News with an S handle on X. It's
you
time.
Like that post?
I did. Yeah.
I don't know. We'll see. Some guy quoted me like 30K, but I don't think he even owns it.
I'm the Stock Market Nerd on Instagram. I'm not that big on that platform, so it doesn't really matter for me. But like you, this like Stock Market Nerd handle has not posted in a decade. It's like, can I just have that, please? And pay you some money and we'll be good to go.
We're also on the call with someone who has future investing missing the eye. So you get it.
What do you think getting that eye will cost me?
On YouTube? Oh, on X?
On X.
It's a good username. Future investing, I like it. You're probably like I have no idea.
Followers or something.
I don't buy accounts. So my guess is like not that crazy. Like under 5K is what I think. Like if you really want it and it's a business, I don't think, but I don't have a great answer to that.
Anyways, guys, that's off topic. We all know why we're here. We are here to talk about Open Door. No, I kid. But
what a day Open Door has been having. There you go.
I know, another 7.7%. We're about to hit $5 per share, but I'm going to assume you guys don't dabble in that name, but let me know your initial thoughts.
Not to brag, I have a name on my portfolio that's doing better than Open Door today. One name. It is LEU. It's a nuclear enrichment name, but that's it. I'm not a big Open Door guy. I've been playing that theme through RKT and honestly SoFi a little bit. Like all of the good stuff that Open Door is going to get, SoFi is probably just doing it better. So I like the theme, but I have not dipped my toes into Open Door. I can't lie. Seeing the thing I see the most about the stock is someone outside Drake's house talking about it. It doesn't get me like super in depth. Like, yeah, I'm going to go buy in.
Brad, you big Open Door guy?
No, not particularly. I think, I mean, if we get a point or two of rate cuts and then through 2026, like we're probably going to with the new Fed chair, whoever that's going to be, probably good for selling homes and for mortgage, for whoever has mortgages and lowering cost of capital and making assets cheaper to buy. But I think there are just other places. There's a long list of other places where I would play that thematic cycle before Open Door. But I do wish everyone the best of luck with their investment there.
I agree with that. And I got to say, I'm very excited about that rate cut theme, not necessarily in itself, the opportunity it might bring to some companies that have been great and kind of been left behind by the market. SoFi was one of those for a while, but now it's had a move. We'll see if it could do a Robinhood breakup of all-time highs and then rip. But that's a theme that I'm very interested in right now. So I get why people are going into the Open Door one. I don't necessarily get why it's Open Door itself. What platform was that, by the way, that you... Yeah, go for it. Sorry.
Oh, no, I was just going to say it's a theme that Brad's been investing in for some time. The SoFi theme.
Oh, the SoFi. Oh, many better ways to play that theme. Was I that obvious?
I don't know. Maybe for me but what do you guys think about that run up, by the way? I mean, honestly, SoFi, I think it's having a red day today, but red meaning still above $26 per share.
I'm calling customer service. Like it's supposed to be green. Like it's not supposed to be red. This is terrible. But in all honesty, I think, you know, it's been, Tanner, you've been talking about this for probably 3 years now with your YouTube people. Like sentiment and fundamentals just not correlated for this name for a very long time for whatever reason. Any kind of we're raising capital, it's going to be it's going to be accretive to earnings per share, and it's going to help us grow the balance sheet faster and make more money and print more for shareholders. Gets punished for years. It was whatever they did was just kind of I guess like understood by bears in a shady and unkosher and unfair way. Like whatever they would do with their fair value markings didn't matter if capital market pundits over and over again would pay gain on sale margin in excess of those markings for every single capital market sale they've ever done, people just didn't believe that the fair valuations they had on their loans. And it didn't matter that they hedged away all positive benefits from those fair value gains in the results. It was still shady, and they were still unfairly like. It's just like listen to what they're saying, read the filings, and then these arguments that you're making will not be rational anymore. And unless you think this person or the CEO has been trustworthy since the IPO, the army guy who worked for Goldman Sachs and Twitter and has a great reputation wherever he goes.
Yeah.
If you think he's full of it, then that was the only way that this wasn't going to work at some point. The timing was always extremely uncertain, but margin accretive compounding was going to win eventually, and it has. And I think macro is certainly helping. Expectations for more rate cuts. That's great for the business. But I also think that the transformation they've done with lending platform business is a big help here too, because not only are they not. I mean, it's the growth for the vast majority of the business has been tied to balance sheet growth for a very long time. It's been asset heavy. It's been you want to have more earnings per share. You need to originate more loans and take more balance sheet risk. And that's no longer true. I mean, between Blue Owl and all these massive private creditors that are lapping up this credit with a spoon across cycle, they no longer need to stash on the balance sheet. So their lending business is quickly turning into a fee-based asset light machine. And I know, well, people say, well, Upstart is too, and that name is a little precarious across macro cycles, but we have to remember that. So the vast majority of this credit funneling through LPB is ultra prime. So they continue to cater to extremely high quality borrowers. They're expanding a little bit into near prime, which makes me a little nervous, and they'll have to execute there very well for LPB so that they're not too cyclical with capital market demand. But I mean, what they've done with lending platform business over the last year, what they've done over the last 5 years in terms of continuing the growth engine and continuing to meet promises, despite the student loan moratorium, despite all those rate hikes, despite a regional banking crisis, despite no excuses, just execution, just doing what we told you we were going to do or better. So it's gratifying to see the company go from $4 a share or whatever it was at the bottom to 26. But it's not surprising. I had no way of telling you when this was going to happen. But as long as things continued to look exactly like they looked for this company for so long, it made sense that it was going to happen at some point, and it felt somewhat inevitable, again, unless you thought someone who's fiercely trustworthy is just full of it all of a sudden. But yeah, that's what I got there.
Yeah. I have a question for you, because you said now that they're expanding their credit box right now, that is a little bit worrisome and they need to get their execution right. Is that just because the growth could end up like eventually we're going to need to expand past that credit box because we're taking such a large percentage of the overall market? So how do they continue to grow without growing out of their credit box? I mean, they're not taking it on their balance sheet. So aren't they doing it in the most effective way?
I think it's going to be a very, very slow, gradual credit band opening for LPB. I don't think it's going to be we'll originate 620 FICO score people and free for all as long as we're giving it to these capital market buyers, because the capital market pundits are telling them that they're saying we will only take loans from you with this level of credit worthiness from the borrower, with these parameters, with this duration, so on and so forth. So they're not going to be able to just say we're originating whatever we want to and selling our shit to everybody else.
Yeah.
Like so that's good. I just mean that, you know, they've done such a great job in this fintech disruptor realm of sticking to ultra prime customers, which is so helpful for when macro sours, not your balance sheet not blowing up and your results hanging in there a little bit better than they do for everyone else. But you're right. At some point, they are going to have to, if they want to keep finding all this loan demand and stop saying no to as many borrowers as they're currently saying no to, and take more than a tiny referral fee they're getting from Lantern, they're going to have to start catering to these borrowers. But the exciting part about that is they get them, okay, as long as they're not burning capital market trust, and as long as these loans are performing like they have across cycle, and it's going to be important for that to continue for these near prime borrowers, not subprime, not terrible, near prime. They get these people in the top of funnel product ecosystem. They get to keep ownership of the customer relationship. They get to cross sell them all these other products they're working on. SoFi Invest rapidly improving the credit cards that I have an 800 FICO score and they still won't give me one. So I'm not really sure when that's going to happen, but at some point I'll have a SoFi credit card and we'll be able to report on how it works and how it works. But there's so many there's so many opportunities for cross-selling these borrowers where they're not super reliant on them being the most highest credit quality borrower out there. Like think about a high yield savings deposit account. Think about a brokerage account. Think about a debit card and things like that. You're not as reliant as you are on them being affluent as you are when you're originating credit, when you're letting them borrow money from you. So I think it's going to be threading a needle of very slowly and gradually opening things up while clinging to ultra prime as tightly as they can. But I also think it's going to be strategic who they're opening this up to. I think, and they haven't really confirmed this, but it makes sense to me that they're going to be expanding to younger borrowers who are working their way towards ultra prime, who are showing clear signs of getting there at some point, so that they do have them in the product ecosystem and they can cross-sell them everything. And in the future, if they need to take out another loan, they aren't 100% reliant on doing so through capital market buyers because they're actually comfortable with originating this credit now. So it's going to be a balancing act, and I think it's going to be an important balancing act and something to pay attention to. But I have so much confidence in this team and executing and overcoming obstacles that it's a balancing act that I'm pretty confident in.
And what do you think about the valuation right now? Obviously, with execution, they can get a little bit of credit and a multiple. Look at like Costco or something like this, right? If you have high certainty that they're going to do well, you can kind of price them much more expensive than their competitors. But
yeah, it's gone, for context, it's gone from, I'm just pulling it up on Ticker. It's gone from 43 times forward earnings to 66 times forward earnings in 6 months. So sounds expensive. I think just a very important thing to also consider, and let me do some very quick math. 72 over 72, 15 to the power of 103. Okay, 69% 3-year earnings CAGR this year, next year, the year after. So the PEG is still slightly below 1x when you're using 3-year compounded growth, which I think is better than using individual years. So the overly simplistic Peter Lynch rule of cheap or expensive, it's still in that cheap category. But it has gone from absurdly dirt cheap to flirting with fairly priced. And I think, as always, that diminishes risk reward. When great companies are more expensive than they were 2 months ago, expectations for forward returns are at least moderately worse, all else equal. And I think this company has gone from dirt cheap to sort of kind of cheap and maybe fairly priced. And I know 65 times earnings for traditional investors and for people who are focusing on PE sounds extremely lofty, and you're right. But I think that's why it's so important for companies like this to be focusing on profit growth, because that's how quickly the multiple can contract over the years if the price doesn't rise. Like the faster profit is growing, the more quickly that multiple is going to normalize and become something that you're more used to with like a Visa at 25 to 30x or something like that. But yeah.
I'd love to ask you guys, because obviously we're the rate cut theme with Jerome Powell's Jackson Hole press conference, and maybe it's coming in September. What does like the SoFi's profits, net interest income, obviously going to go down, but I'm curious on like the loan duration too. Is it a little shorter term where it will maybe get impacted more directly, or a little more longer term where it will get, take a little bit less? I'm curious. First of all, the first question is, what's SoFi's general like loan duration? Yeah.
I have to pull that up from their 10K.
Yeah, my guess would be that the majority of their loans are personal loans, which are about 4 years on average. Now, what the season, like how seasoned their loans are, Brad will be able to bring up what the average is. But overall, rate cuts, I think, allow them to sell their loans into capital markets much quicker. And SoFi does not want to hold on to too many loans. If they can rotate those loans out, sell them, and then re-originate more and find the customers to do that, that is, peak SoFi business model. That's what we were doing 100% before we had a bank, right? Because we didn't really have the ability to hold those loans much more than 3 to 6 months. So, I think that it'll definitely benefit them on some of the actual interest earning. Of course, for new loans, we will end up writing new loans at lower coupon rates. But the difference between where the rate sits at for risk-free rate versus what certain institutions could get personal loans for SoFi for 13.5% or something like this, that gets a little bit more exciting as rate cuts come in. So you would see their gain on sale margin improve, which I think helps them in the short term.
Yeah. And I think for loan duration, the best way to think about it right now is kind of a blended personal and student, just because mortgages are not such a tiny part of the business. So personal loans, like sometimes they're as short as 18 months, but they can get up to 5 or 6 years. Student loans, 5 to 10 years, generally speaking, can get longer. But I think a more important, like besides blended loan duration, and I have to find that exact number from the filing, and I don't want to sit here and let you guys or have people watch me staring at a screen for 5 minutes. But for in terms of vintage analysis, they've done a lot of that over the last several quarters. And we do know that, so from Q4 2022 to Q3 2024, so that should be a very sizable chunk of their personal loan pool. Net cumulative losses are significantly below 78%, and 59% of that total principal has already been paid. So for a lot of their credit, and then I guess going from Q1 2020 to Q1 2025, it was like some 40 something percent of that principal had been repaid. So in terms of duration, they're not really sitting on massively elongated loans that are going to be really vulnerable to rate cuts and have a lot of fixed credit that they can't refinance and help net interest margin. So it's not something that I worry about all that much personally, but yeah, always something to keep an eye on for creditors.
Yeah, I'd say there was a big pool of student loans that ended up getting killed because they wrote it before rate cuts increased, and then they essentially just wrote those off, if I remember correctly. I don't even think they're written for sale. I think they're held for investment now. So that impacted the company a little bit, but not big enough at the time to hurt their business, because obviously they were growing so fast during that time as well.
Yeah, and I guess just in life of loan loss rates they have sold some late stage delinquency pools that it's somewhat of a similar idea, and I think that's I mean, it's a normal part of banking operations. It's not shady. It's normal, but it is something to consider. And their life of loan loss rates are still below their target, even when adjusting for that. So probably a better metric to keep an eye on, because they do disclose that every quarter, adjusting for these sales that they've done a few times in the last couple of years. Their credit is still trending well below what it needs, or their credit health or credit losses are still trending well below what they need to for them to keep feeling confident in originating credit, as macro tailwinds again kind of start to rage, and we probably get more rate cuts over the next 18 months.
Any other questions, Brad? Or sorry, Evan?
On SoFi, I mean, I have more questions around the I was looking at the businesses, the technology platform, and how that one would end up kind of.
We all have questions about the tech platform.
Yeah. I think 2026 is going to be a year where it either kind of comes together and all the headwinds they've been dealing with. Between,
can I ask, taking a step back, I'm just looking at the numbers. Looks like $400 million of revenue and like $2 million of profits. What's happening in this segment?
The tech segment?
Yeah.
Are you looking at
nope, I'm looking at net interest income. I am completely lying, actually. Wow, it's actually a pretty good segment. Sorry.
Yeah, as long as it starts growing again, it'll be great. Growing more quickly, it'll be a great segment. And I think
it's actually their worst segment, though.
Yeah, right now, absolutely.
It looks like all of it is interest income, or kind of goes to income.
I mean, it's a very high margin and very asset light business, but it has not performed that well for the last 2 years. Just like most enterprise software firms selling financial service technology to companies have not really done well. Tim Hortons, that's so on brand, Tanner. They've really not done well over the last few years. Regional banking crisis, cost of capital went through the roof. So that happened while SoFi embarked on this go-to-market transition, where we are no longer pursuing low-hanging fruit, small, lower quality customers. We want big watershed customer win moments. And that happened while they were also trying to integrate this pretty massive M&A piece that they bought with Technisys, while they were trying to put this all together. So all of that's kind of wrapping up, and now you're hearing commentary about the pipeline swelling and 10 plus clients contributing to revenue in 2026. And this customer left and realized we're way better than who they left for. Now they're boomeranging back to us. So there are a lot of signs that things are looking better, as they're supposed to be looking better right now, because macro is getting more cooperative for these companies. So 2026 is really going to be when we need to see that growth engine meaningfully accelerate. Maybe not all the way to 20%, but pretty close to 20%. Or it's going to be pretty hard to remain optimistic about the segment, because they have been optimistic for a while. And it has been underwhelming for a while, and financial services has really picked up all of that slack and then some. So it'd be super exciting to see that segment really start to contribute. while financial services and lending remain in as good of shape as they are. But we'll see in 2026. These are signed contracts. They are onboarded contracts. They are ramping next year. Every reason to believe it should happen, but it's been a while since the tech platform's been a strength. So kind of want to see points on the board before we start pounding our chests, I think.
Are you optimistic, Brad? Because I think there's sort of two schools of thought. Maybe one is larger fintechs or banks don't want to deal with it because it's parent owned by SoFi. And then two, the comments that Anthony Noto said about some of the larger fintechs that have left are now coming back because their homegrown tech is not as good, even though they might be saving pennies, they're losing dollars.
Yeah. I am optimistic, and I'm optimistic because this expectation of a 2026 looking way better than 2025 is not based on, well, these customers are in the pipeline, and so some of them are probably going to close. So we'll assume X% closes, and then that means 2026 will look like that. These are signed contracts that like the federal contract, Wyndham, all of these debit programs are signing, the co-branded debit card programs. They are signed, sealed, delivered, and just onboarding and ramping into 2026. So that to me takes a lot of the execution risk out of banking on that acceleration. But again, I want to see it because, like you said, this has been the worst segment for the company for, I'd say, 4 years at this point. So
even on a margin basis, though, is what I was also referring to, is like, financial services has climbed up their margins so much. I think we're over 50%. Lending's also over 50%. And essentially the tech platform has stayed completely flat.
Yeah, I think that has like you alluded to, a lot to do with how impressive financial services has been in terms of that margin explosion that they've delivered. How many points of expansion? I could pull that up pretty quickly.
Year over year, we went from 31% to 51%.
From Q2 2023, we've gone from -4% to today 52%. So that just gives you a sense of
what exactly is that financial services segment. Like what type of business is going on in there? Is it like is most of their business B2B, or is it a lot of B2C in that segment?
It's almost all B2C. I guess you could call capital market loan sales B2B, but that's after they've already had a B2C transaction. It's all consumer facing, but deposit or their high yield savings accounts, their debit cards, SoFi Relay, which
credit cards as well.
Organized, SoFi Invest, which has been a really underloved product for a long time and is finally starting to get the attention I think it deserves and needs. And then lending platform is also part of financial services as well. The vast majority of that is part of financial services. There's a very small sliver that's part of lending, but it's mainly that.
Yeah. By small sliver, he means like 2%.
Yeah. Gotcha. Thank you.
Who in general do you think they're like taking market share from, or is this just an expanding pie? So are we talking like regional banks? No, there seems that generational, wealth movement, that wealth transfer theme that is going on in Robinhood is definitely going to happen up in this other sector. And imagine a lot of the traditional people have money that maybe is going to the SoFis, the upstarts of the world, that would be in a lot of regional banks and other places like that. So I wonder if that's where the shift is coming from, or it is just an expanding pie.
Well, I'm sure there's some expanding pie in general, but I think whenever it comes to the JP Morgans and the Wells Fargos, I even saw an update just recently that they're increasing their monthly maintenance fees for people that don't hold a certain amount in their accounts. Like, they truly don't even want those customers on their platform. It's just costing them too much for them to have access to a full advisor and come into a branch and speak to somebody. It's just too expensive. SoFi and a lot of the other fintechs can handle those types of customers, and then they can grow with them, right? So SoFi, I think, takes on a lot of customers that are young in their financial life, and then obviously grow with them while taking on products that are immediately accretive for SoFi as a business through lending. So, while the debit and like the checkings and brokerage have started to grow, they're still very small products, especially brokerage. I mean, they're absolutely tiny. But that'll grow over time as customers set up shop with SoFi through direct deposit and some sort of loan product and everything that is immediately accretive for their business. But I think that there's a massive mountain of legacy accounts, and they are not taking care of their customers as well as they should be. And so Robinhood's getting to take a piece of this, Chime, SoFi. I don't think that it's just one individual winner. Obviously, there are winners that stick out amongst all fintechs, but it just sort of seems like a little bit of a feeding frenzy for the customers that do end up, which is usually happens with some sort of bad experience or job change that ends up making them look for a new bank. And what I think is really unique to SoFi, and Brad, you can have your own opinions on all of this, but for every $300 or so that SoFi spends for customer acquisition, they get a new customer. And that's pretty unique in the fintech space. You really can't find another fintech that has as consistent of customer acquisition, and it makes for modeling the company really great. And I think that gives SoFi a lot of flexibility. And right now, I think we're in full growth mode. So I think the sort of explosion that we saw from Robinhood, I'm not saying SoFi will have a similar event, but a similar perspective of going from, maintaining a business and survival to full-on growth. I think SoFi is now in that phase and has been probably since Q3 of 2024, which was when the loan platform business took off.
Yeah, and now enter crypto, so that'll be another lever. But I mean, yeah, people get on. One of the bear cases I see for this company a lot is, man, they spend so much money on marketing. I mean, wouldn't you spend that much money on marketing if it was that effective, if it was that efficient, if it was that profitable, if you were adding customers that efficiently? You'd be stupid not to spend that much on marketing. You'd be short-sighted. You'd be maximizing profit for a 3-month period, which is not what this kind of company should be doing at all. But in terms of who they're taking market share from, I fully agree with Tanner. I don't think it's. I mean, I'm sure that there's some customer movement between SoFi and Robinhood and between SoFi and Chime and that. But I think it's JP Morgan. It's these massive money center banks: JP Morgan, Wells Fargo, Bank of America. That is who they are taking market share from. That is who can't afford to pay. I mean, these cost structures and balance sheets are so tied to being able to pay 0.00001% on a savings account and a checking account that they can't just be like, oh shoot, SoFi's here, we're going to start paying 5% or 4% to all of our customers, not just our extremely wealthy customers who we take care of and match them with more yield. They can't afford it, and SoFi can't afford it because they haven't built a business reliant on net interest margin from actual deposits, and they don't have massive branches with bank tellers working 40 hours a week all over the country, adding to their fixed costs, and they don't pay vendors for every single API they need to use to power their tech stack because they own all of it. So it's this theme of competing on marginal cost, allowing you to stand out by passing on more unique differentiation to your customers profitably than the other customers can, and they are able to do that. Robinhood's able to do that. Chime is able to do that. So I think it's just going to be continuing to see market share ceded by these 3 still massive money center banks and everyone in that same conversation to the disruptors who are just offering clearly a better, more convenient experience than the incumbents.
One thing also around that long-term value of a customer, and I'm a big fan of Robinhood. We talk about here. One thing that I do that I think that is a little bit of a mistake there is their heavy focus on margin. Yeah, it's going to make you more money now, but does it get people to burn out and then make you less money in the long term? And I wonder when I kind of look over to SoFi, loans aren't something that I'm like, all right, guys, you are giving me access to money, but you don't sit there and think about, oh, I'm so thankful for this loan and everything like that. So my question would be is like, how are they ensuring, even like the student loans thing, like how do they ensure that you're actually having a good experience on this app? For me, it was even as simple as I didn't have the ability to do direct deposit a couple years ago, so I didn't use SoFi. Now I know you don't even need that anymore to get the high yield savings account, but I still haven't gone over and used it. So sometimes it's some simple little bit of friction or one negative thing. So I'm just curious. Loans don't seem like something that people will get excited about and like love the company for. How are they making you actually enjoy using the app and keeping you in?
Tanner, you want to go first?
Yeah, I think
Canadians even use it.
On the Robinhood side, I think that is their margin stance, is that if that was the reason to stay with an existing broker, is that they have great margin products and that usually lends itself to a much larger customer. I think that they're just trying to knock away some of those missing features that is holding people back from coming over. So I think that that's why they're big into margin right now, because they're actually acquiring a lot more high net worth customers. That being said, with SoFi, I think that a lot of investors look at SoFi and they only look at the SoFi Invest product, because that's the product that we would have a lot of, interaction with. And that's the audience that, 6,000 people watching right now would be focused on. But for my girlfriend, for the average person, it's about lowering their cost of debt and, making their financial lives just a little bit more secure. So I think that that's what SoFi is focused on, is a little bit more of the normie, like
sprinkling in a little bit to an ETF here and there, like that. Yeah.
Yeah. Manage portfolios, set it and forget it, auto pay on credit cards, debt coach, things like this, like easy access advisors, financial advisors, and really easy to pay off loans with decent pricing and flexibility on those terms. That's sort of the reason why they're winning so much in student loans. It's not just, sheer dollar amount, but it's the flexibility. Hey, you know what? Your federal loan might be X. I think it's 10 years or so. SoFi will allow you to extend it out to 20, and that will lower the actual monthly payment. You'll pay more throughout the entire term of the loan, but they're also very transparent to tell you that you're going to pay more over that entire term. But you can lower your monthly rate, or potentially do interest only for the first few months, or that's what I think is very great. And if you go on SoFi Reddit pages or different forums online, you'll see that those average people who are using SoFi are very grateful for those lending products.
Yeah. And I would say, so how do you ensure the experience and you were asking about experience and service versus everybody else? I think that's why it's so important that they own their back end. I mean, that's why they bought Wyndham Capital for their mortgage business, because they were beholden to third-party vendors that just were not fulfilling loans quickly enough, didn't have enough uptime, didn't have effective customer service. Just the experience sucked. So they haven't been a big player in mortgage. Well, I mean, part of it's been macro driven because rates went through the roof, and that's hard for every mortgage vendor. But they haven't really gotten a chance to scale the business with an owned back end where they can control the process, where they can go take customers from start to finish in days rather than months, until with a cooperative macro environment until right now, which is why I think everyone's pretty excited about the home lending business, and that being, I guess, the next leg of growth. They just have this massive base of customers already sitting on their app, already with mortgages. They can undercut a lot of the interest rates that they're paying right now. They can refinance those profitably for customers routinely while still making a lot of money and having a high ROE franchise there. So yeah, it's owning the entire experience from start to finish. I think,
including why they became a bank as well.
Yeah, I'm realizing that right now with on a much smaller scale with a fully custom site, and wanting to own and be in control of every single part of the customer experience and every single customer touch point, because I don't trust other vendors, and I don't want to rely on other people except for myself. And I think that SoFi has taken that exact same approach at a tens of billions of dollar scale, and I'm a little peanut. So again, not comparing myself to SoFi, because Stock Market Nerd will not be as big as that for at least a year or two, I think. No, I'm kidding. But yeah, I think just vertical integration of their back end has been so instrumental in making sure service scores are elevated, and that these loans can be a top of funnel product to actually delight customers and create surprise, because they're not used to liking their lenders and then buying or opening up a high yield deposit account, opening up a brokerage account, opening up a credit card, so on and so forth.
I can't lie. I really do want to talk about Nvidia, but you sparked another stock with one of the comments there that I want to ask you guys about. I'd rather go to Nvidia first, but I may slip in a TTD question towards the end of this.
Okay, go for it.
What Nvidia? Do we want to? Are you guys good on the SoFi topic? I'm good to keep talking about it.
I can talk about Trade Desk if you want. Then we can go over.
No, let's go to Nvidia.
The SoFi thing. I've been talking about it all day and all night. Let's
Congrats
talk about something else.
First of all, before we move on, I know it's not quite all-time highs. Those were fake all-time highs. In this channel, we're calling this all-time highs. What yesterday was. So congrats.
Yeah, I guess it was IPOE when it touched 28, but it's still.
If Chamath was anywhere near it, if Chamath owned it, it doesn't count.
It was an all-time high close. The $28 was an intraday move, so it was a high close.
Okay. Well, it feels good regardless. So
yeah. Oh yeah. Yeah. It's a high for me. I mean, I was buying at $14 at first and then had only watched it fall down. So even seeing green as a SoFi shareholder is new to me, which is
I am
fun.
a new shareholder for the first time following that last earnings, and I bought a little bit above that too. 22.73 is the cost basis right now. And
There you
I
go.
was talking with a friend, Hamid, who was kind of challenging me. He saw my portfolio, saw how like I like QQQ and other stuff, and was like, just pick the 5 names you like the most, throw it in a separate portfolio, and I bet you that outperforms it. So SoFi might be one that's going in that portfolio. But Tanner, I know you are a big Nvidia shareholder. I own a good bit. Brad, I don't think you've been an Nvidia shareholder. I know you've watched it. We're a fan. But Nvidia earnings is tomorrow. There's that chart. There's that chart that's been going around Mag 7 capex spend. I think it's like Amazon, Microsoft. It's 4 companies. It shows last 2 quarters before this one, they were spending around 60 billion, let's say. This quarter, they're going towards $80 billion on capex. Conclusions we're going to get from this is any numbers that Nvidia are going to print are going to be strong. The question marks, as always, forward guidance, and it's only around China. My real question on this earnings call is that $5.5 billion write down that they did a little bit ago on those that generation of H20 chips. How many chip sales were they able to just stuff through in that 2-3 week period, whatever it was? My guess is a good bit. But that's to me is the only question mark. Yeah.
My understanding that some of that 5.5 billion was also being already repurposed for other things. Not all of it, but yeah, they will be able to probably pull forward a little bit of China sales. But also, my understanding is that the China guidance is not, or there is no Chinese sales guidance in their numbers. So that also is pretty interesting.
How interesting is that going to be? And then you've also seen headlines like Chinese buyers have been instructed not to buy H20 anymore.
Yeah.
So where is this going to shake out? But sorry, go ahead. I sorry.
No. I think that's an important case, but like people are getting caught and arrested for smuggling chips over to China. So I don't know. I don't know if those instructions are going to mean all too much. I mean, even with 2 governments saying absolutely they will not do deals with each other, somehow chips were still making their way into mainland China. So who knows?
I think there's a couple things in that. One, great management is not going to get you offside. They're going to underpromise, overdeliver. There's none of this in there, so all this is upside. Yeah, listen. There are certain companies, there are certain CEOs who tell you something, and it's a certain timeline that's not going to hit, and maybe you adjust to that. There are certain people who tell you big things, and they hit it, they get close to it, they're whatever. Jensen Huang is clearly earned that. So all the China stuff is only upside, really.
Yeah, I think important context. Yeah. Nvidia's Q2 guide is $45 billion. Analyst Q2 estimates are $46.2 billion. And that gap, a little bit is them knowing that Nvidia likes to outperform, but I think a little bit of that is some of this H20 China revenue maybe being part of that quarter.
47.5.
Watch. I think it'll be a beat as well, on top of the Wall Street expectations, but we'll have to see. I mean, it's so freaking close. I'm getting very excited, but for me, it's also a long-term play. So I know that I'm not in this just for the next few quarters. Did you guys see the report that? And honestly, Evan, maybe you reported on this, but that Nvidia is the most under-owned name versus the versus the S&P 500 weightings. Did you hear this?
How does that work?
So basically what it's saying is Nvidia is like a 13 at 10, 12% weighting in the S&P 500. And it's like in those ownership, it's closer to like 4 or 5. And that delta is more than any other stock. I saw that. I was not the one who posted it. And I'm not totally surprised. I'm not totally not surprised, but yeah.
It's like the Winston Churchill quote thing. Like if I don't know who posted it, it's just Evan's post because there's a good chance that you did post it. So
I think it's a good strategy. I'm bullish on it. Unless it's fake news, unless it's wrong, then I think it's bad. But I wouldn't be totally surprised. I was looking through the 13F filings and all that stuff, and there was not a lot of Nvidia. There was equal amounts of like Tesla ownership at the top as Nvidia, which isn't generally a good sign for your institutional ownership.
So yeah, I mean, I think on the quarter, and can I go back to that CapEx point for a moment that you were talking about? So, and we've talked about this a few times in the chat, but a lot of that's going to go to Nvidia GPUs. A lot of that's going to go to AMD GPUs. A lot of it's going to go to more energy. A lot of it's going to go to more server racks. So on. A lot of it's going to go to Ethernet equipment. So I do think, like, just putting a fine pin on that, I do think that it is a very positive data point to see exploding CapEx for Nvidia. But we shouldn't expect a 1-for-1, which neither of you are implying. But we shouldn't expect a 1-for-1 correlation with their.
But here's the thing, Wedbush, take what you want. They put out that right now they're seeing that Nvidia is 10-for-1 oversupplied on demand. I'm not saying it's that, but I am saying
oversupplied,
that there is 10 supply for every 1 demand they have right now.
So they have no demand, is what you're saying. That I don't.
No, sorry, wrong way around. They have.
Tanner's like,
supply
they have 10 demand for one supply.
Opposite. And I said it with my chest the second time too. No, total opposite. That they have not enough supply for all of the demand that they have. Maybe it's not 10x. But
I was just, I heard what he said, but I was like, that's just not what's happening.
That's not.
That's the first time I've ever heard that.
But the point, like, so it could. My point is it's not going to be 1-for-1, but there are some quarters, and maybe this isn't a good thing, where it could be more than 1-for-1 because they increase their supply so much. But that's kind of just a pull forward of demand, and would bring down margins. So I'm not saying that's the best thing, but Nvidia is still in a supply constrained place. 3 to whatever years later.
Super uber amazing cycle. I don't even know what to call this cycle at this point.
There's been nothing like it at this scale.
Nothing remote. I mean, right before the 5G rollout, everyone's like, all right, here comes the super cycle. And it was, I mean, there was definitely demand tailwind, but this makes it look tiny. And very, very ephemeral and very small. So yeah.
I also have been thinking more about the energy bottleneck that people have been talking about. I actually think that is very negative AMD and very positive Nvidia, because the different. Sorry,
because like better efficiency.
Yeah, and that if energy is the bottleneck, then you need absolutely the best chips, and that is very interesting to me. And the more I think about it, I'm just like, man, Nvidia has such a long road, and energy won't slow it down. I actually think that it increases it because it puts the importance on the quality of the actual chips and how much you can get out of a single, like NVL72 rather than what the AMD's, I forget the name of their 8 chips that tie together.
MI400 will be the one to keep everyone.
350, 450s.
This takes me back to that Jensen Huang quote, and it's like, even if our competitors gave them their chips for free, it would still be more expensive than using our chips.
That's a fun fact,
and that's like a 2-year-old quote, and I bet you it's still true.
I think AMD's they've definitely closed.
Maybe the gap closer.
We saw that. I mean, you saw that headline, but Nvidia immediately said is wrong. But that Rubin was getting delayed because they needed to better compete with AMD with MI400 that's coming out next year, and then Nvidia immediately said wrong, on track, like we're the best. So
wrong.
Yeah, basically. So it's, I mean, I think almost for Nvidia shareholders, you guys should be, as long as this isn't structurally cutting into your demand, which it's hard to believe that's happening with things is still as a supply constraint as they currently are. I think a little bit of negative sentiment from AMD sort of catching up and cooling off shares a little bit can for the shorter term minded people can lead to some upward surprise in results and can deliver some positive share price movement. So I'm not saying that's going to happen. We'll see how the quarter looks, but sentiment isn't as overwhelmingly, amazingly positive for this company from everyone who covers it quite as intensely as it's been for 2.5 years, maybe at this point, I think.
I mean, to be fair, I mean, the beats as a percentage of a surprise has shrunk. It seems like the market is understanding just a little bit more how to understand their earnings this time and doing many more channel checks with real customers and these sort of things. So I do think like some bit of like, oh, this earnings is going to lead to a 20% pop. I think we're past those days until we have, some new catalyst. Maybe that's robotics or whatever that allows them to sell into more customers that maybe we're not expecting today. For example, their Thor chips that in the early customer list, I don't know if you guys saw this. It was Figure, it was Boston Dynamics, it was Amazon Robotics, and Meta. I don't know if anyone cares too much about that, but I thought that was interesting.
For like early access to.
Yeah, they're like autonomous for AVs and robotics.
Interesting.
So all physical AI.
Interesting. Does that have anything to do with smart glass? I don't.
No, these are.
No, I wouldn't. Yeah.
I am buying those Meta smart glasses with a display the first day. I am buying it. $800. I might buy 2.
The what? The Orions? Which one are you talking about?
Is it Orion? I don't know if it's necessarily that one. I don't think it quite is. But Meta has smart glasses that they're rumored to be releasing next week. They're going to be their first ones with like a heads-up display on them.
I thought it was at Meta Connect. Is that next week already? Jeez.
Is it? I think I said next month. Maybe I said next week there. I just know in September.
Soon, very soon.
Very soon. I'm going to buy it first day.
It'll be an exciting product. I mean, for as terrible as Quest has been, terrible, and some people at Meta would fiercely argue with me that it's been terrible. They just say that we are creating an entirely new industry and it takes a very long time and we have to spend a lot of money to make sure we're building it. But that argument aside, Ray-Bans have been such a home run hit for this company since they came out. That they've increased supply or ordering twice, and they still are flying off the shelves, and they still can't keep them stocked. So exciting to think about what this business really becomes as everything you can do on those ski goggle, sweaty, nauseating headsets is miniaturized down into something you can do on what Tanner is wearing on his face right now. It's an exciting time. I think Apple should be moving as quickly as they possibly can here and buying up companies and acting like they should, in my opinion, they should be acting like Meta did when Apple cut off data sharing for their apps. Like they should be spending like crazy, moving like crazy, making this priority one. But I don't think they are. But your stocks, is that at all-time highs right now, Evan? Can I say congratulations? But it's near.
Apple is not at all-time highs. No, we're still at $30 off.
Oh, it's $30 off. My bad. But it's still Apple, so they still have the blue text bubble. And I'll still have it for a long time. So,
you know what I will say, Apple over the last week or so, we've had first rumors that now they're going to maybe use Google's Gemini AI to power a revamped Siri. They have stuff around new iPhones. This year maybe it's going to be an iPhone Air. Next year a foldable phone. The one after that, a one with curved glass. And then they just sent out the invites to the Apple event, which, by the way, new iPhones will be coming on September 9th at 1 p.m. Eastern. Support my stock, buy a new iPhone. I'm kidding a little. I actually think I'm going to upgrade this time. We'll see. Apple loves to do a good run-up into the event. I'm not saying this is the best long-term stock right now. This is probably a good swing period. I might have 240 calls. We'll see if it gets to that by the launch event. Check back in a week or two. I think innovation was probably never too far gone at Apple. They just aren't really salesmen of like future stuff that they're working on. But, they're playing the game now. So we'll see how long this lasts. But people are getting a little bit excited about Apple innovation. Maybe they still think it's gone, but from where the stock was trading at, expensive, but with a lot of hatred moved into it. I don't think it takes much to go from hated to back to being Apple, and we'll see. Again, I understand why you guys aren't in it for the long term. I'm not necessarily running to add here, but
I'm not all that bullish, dude. I think the which I already know, but like I think all the deals that they're making in artificial intelligence just gets me excited for OpenAI and for Google. Those are the names that I would be really interested in. And also, I'm curious if you guys would take stakes in
the Google search deal. They were paying them like $20 billion a year to be the default search engine. to be the default AI on Apple, $30 billion, 40, I don't know what it is going to be or something like that. I mean, it did kind of get struck down as anti-competitive, so who knows? But all of that just as profit, no expenses, just for the ecosystem, is not the worst thing.
18 months
$40 billion of extra.
Wiz. I mean, then there's Wiz Cloud security and paid for. So and maybe they will get a lot of that back with Gemini running Siri right after we hear from the judge on if this is going to be allowed or not, and they appeal until we get a final decision. But
imagine if we get the search revenue allowed and then we get a $30 billion of Siri revenue. Now it probably eats into it, because who's going to search when you have Siri? Apple. That's a lot of just straight profit.
Yeah.
But that's ifs. So we'll see. Tanner to 50K. How many subscribers you got, Tanner?
46, I think.
All right, we can get there. If everyone in this chat is not subscribed to Tanner, if you're watching this on X, you're not following us, you're missing out. But subscribe, hit the like button. Nvidia to 220.
Are we wrapping there?
You guys want to talk about Trade Desk at all, Evan?
I want to hear your thoughts on Trade Desk. I'm good with that. So for me, one of the things that really Desk. You still own. Do you guys still own it?
No, I sold out.
Okay, I sold out as well.
I can't answer that, but what were you going to ask?
For me, one of the things that they talked about was the closed TV, internet, whatever it was, versus the open one. And one of the things that he touted as something that he was really excited about was the fact that they don't own any content and that they can just work with any. Yeah.
Okay, got it. Sorry, I didn't know who he was. Sorry, go ahead.
Oh, sorry. Yeah, Trade Desk CEO on the earnings call. Yeah, I didn't mention that. But yeah, he was touting that they don't own any content as a benefit, so that they can go in and work with anyone. And to me, I've spent my entire working career telling everyone that you need to own the content, that's what part is actually important, and the advertising isn't really the business. So for me, it was less of a stocks and stuff, and this kind of was brought up for me when you were talking about like kind of working in your like what you're seeing on these companies into your personal life, and kind of working like what strategies I'm seeing in my personal work, kind of work in this area where didn't explain that well. But basically the fact that it's against everything I believe in on what's valuable in content is why I sold out of Trade Desk. And I'm curious if the thoughts on why that's wrong. And maybe it's different at scale, and being able to work with a lot of these companies was one of the things that I was thinking about. But I want to get your thoughts on it.
Well, maybe you're right, but I think the people who would say that you're wrong would say, I think, it's important to own content, but then it's important for all of these companies that own content to figure out how to monetize that content. And that's really where Trade Desk is helping them do so in an unconflicted, unbiased manner. Because, I mean, think about, okay, I want to sell some impressions. I'm going to go, and I mean, this has come out in Google's antitrust suit loudly and clearly, that they've been routing impressions to YouTube, to their own search property, at the expense of other publishers that would have gotten more money, because Google makes more by double dipping. Amazon, I guarantee you, is going to end up being the exact same thing. They have every incentive in the world to route impressions to Prime Video or their own marketplace, because they make way more money than they do giving it to Roku or some other partner. So if you want to spend money on and access the entire open internet, but besides, I mean, companies are absolutely still going to have Amazon budgets. They're absolutely still going to have Google budgets, Meta budget, exact same concept and idea. They're phenomenal companies. They have great reach. They offer very cheap reach. So they'll continue to be big parts of digital advertising. But for Netflix and for Disney and for Fox News / CNN, you like what I did there? Left wing, right wing slashing. So for all of these companies that need to figure out how to monetize their content, they want to plug into the buy side conduit that represents all of the massive agencies, all the massive brands, and they want to have great communication with the buy side. Buy side wants to have a great understanding of who they'll be targeting, of when those people who they want to target will be there, on how it went, and what needs to be tweaked to make return on ad spend a little bit higher. And Trade Desk is just able to do that in a way where you don't have to worry about, could I have made more money if I was working with someone who doesn't have a vested interest in sending my impressions to one other company? Not to mention the fact that for the last, well over a decade, they've cut booking costs for companies in half, which is another way of saying they double return on ad spend for their clients. And I just think when you want granular one-on-one targeting, and when you want that to happen, where you will be reaching the absolute best eyeball, where the publisher knows they will be paid by whoever's willing them to pay them the absolute most. That's how the publishers like Netflix are going to keep spending a ton of money on content to have what you call that extremely important asset and to keep their differentiation going. But that cannot happen unless you're making as much money as you possibly can monetizing that content. And that is where Trade Desk comes in and is why all these streamers have flocked to them. It's why all these retailers have flocked to them, including Walmart. I know there was a headline saying Walmart is backing away from Trade Desk and blah, blah, blah. But just talking to people at the company, like pretty high up at the company, like relationship going from strength to strength, like it's clickbait, like complete BS nonsense. Like we continue to deepen our relationship with Walmart. So I just think the Amazon competitive entrance has led bear cases to run wild with imaginations on what that's going to mean for Trade Desk. If you rewound 10 years when this company was going public, they would have said Google is Google's networking business, which is now being phased out and deprioritized, was going to kill this company. And here they are over 10 years later at their scale, with their reach and with their growth. So extremely negative sentiment for the company right now. I think Q3 and Q4 are going to be very important. They have told us that there is a growth acceleration coming in 2026. That needs to happen. Sell-side doesn't currently believe them and thinks it's not going to come and the growth engine is going to keep slowing. If they want a premium multiple like they've had for a very long time, that can't happen. And what Jeff Green says needs to be true, like it's been for so many years. But two very important quarters, very much so a battleground stock right now. It was a battleground stock 2 quarters ago and then had an amazing quarter and was a darling again. And now it's a battleground stock again. So back and forth we go. But they have some proving to do for doubters that have emerged recently. Reason to believe that they're going to do that proving, but Q3 is going to be super important.
I'm not going to be nearly as technical or smart of an answer as Brad did, but the Walmart news did get to me. I don't have friends in high up places, so I didn't end up checking, but I
work on that. No, I'm kidding.
Brad's like, I just walked into a Walmart. I asked.
Yeah, this cashier. I was like, how's the relationship going with Trade?
we use Trade Desk all the time. But no, I think there's a lot of companies, amazing companies, can end up having disappointing results and surprise people on a guidance perspective, earn like in many different ways. Can they end up surprising to the downside on earnings, even darlings? Okay. That happened for the Trade Desk 2 quarters ago. So Q4 of 2024, that happened. However, the problem is in like Adyen, you can find a bunch of companies that have done this. They find unbelievable re-ratings, and then Wall Street turns out to be wrong, and then they shoot back up to the price that they were previously. And I thought that we were heading in that direction once we saw Q1, which, like Brad said, was amazing. 2 misses in this short period of time does work. Well, they didn't have a miss, but they had weaker guidance than what Wall Street was expecting.
They had weaker guidance than what some buy-side analysts were expecting, but they did beat consensus sell-side expectations. But still doesn't take away from your point that it was disappointing to a lot of people.
They were in line on many like, I don't know. It wasn't as great of a quarter as people were expecting. This was a Wall Street darling. 19% was a little surprising to me as well. I didn't want to be below 20%. I just thought this is like what Brad said, a battleground stock, and I don't want to play in that. I don't want to take a bet on if they're going to do well after not having the best earnings 2 quarters of the last 3. I think that there could be stronger than expected competition, even if it's not for the, like, I actually don't agree with what Evan said. I agree with what Brad says. I think the fact that the Trade Desk is coming in with an unbiased like technology, I guess, is actually to their advantage. I think that that's also why people worry about Braintree or PayPal owning Braintree or SoFi owning Galileo, is there is these conflicts. The Trade Desk doesn't have those conflicts. That actually makes them a very good partner to deal with. So that I actually like, but I just thought, you know what, I'm going to take my chips off the table. And I ended up actually getting into AppLovin, which I think is an interesting rotation, but yeah.
It's funny, everyone who I talk to who hates Trade Desk and thinks they're full of it and thinks they're done and over. They love AppLovin. So maybe they're right, and you'll be making a lot of money. I think the other important risk to talk about for Trade Desk is that their exposure to tariffs is higher than any. I mean, Meta, Google, Amazon, AppLovin, they all cater their skew for digital advertising. Their customer base is way more SMB, small market, which SMBs are far less heavily reliant on global supply chains, which means tariffs don't impact them quite as much as they do for Ford and Volkswagen and Unilever and these giant CPG companies that Trade Desk helps pretty much all of. So tariffs remaining in place hurt this company more than anyone else because their customers pay these tariffs at a far higher rate than anyone else. So they're and also, I mean, Omnicom and these massive agencies that Trade Desk is also working with, you could lump them into that same conversation because they're working with similar clients. But for these pure play software names that we focus on, digital advertising, they are hurt more by this than everyone. So,
yeah, I think that's a really good point. Like I said, I don't know this name nearly as well as Brad. It was a tiny position for me versus what other names that we've covered here today. But
it is fun to cover AppLovin and Trade Desk together and just kind of that's so valuable. I mean, I know it's hard to focus on a lot of companies, and hopefully if readers are in the room, the newsletter helps in that regard to make it quicker. But it's so valuable to listen to a CEO tell us something and then to listen to their 3 competitors and make sure what they said isn't BS and is actually resonating, and is macro terrible for everyone or just for you, like that kind of thing. So
well, that's what I didn't like advertising was a boom this quarter. Like, so it just made me upset. I came in with such high hopes, and then it's funny too. I try not to do this as well. I love Jeff Green. Like, honestly, he's amazing. I've got no problems with him. But it's funny because I live stream all the earnings calls. Every comment as we're watching this and the stock's down like 30%, people are like, who is this goof? Like just tearing him apart. And I'm like, this guy is a legend. Let's not.
Yeah. Legend. It was weird. Every single in the Q&A, every single answer he started with like, that's the best question I've ever heard in my life. Like, congratulations on the amazing question. And then he would answer it. But I think relative weakness versus Trade Desk versus everybody else. Some people they're going to say Amazon or not AppLovin because they're really not competing in the same channels. At least
mainly Amazon now.
Amazon, lesser extent Google and Meta. Like, well, what's going on there? But I think there is reason to believe why a newsletter business like me is more likely to advertise on Meta than I am on. I can't afford to work with Trade Desk. Like my minimums aren't nearly high enough to work with them. So like I'd have to spend way more money than I'm capable of spending on advertising right now, which I think supports the argument that they are working for global enterprises who have businesses all over the world who are paying tariffs far more frequently than everybody else. And so digital advertising for those other guys looks better right now than for Trade Desk. So that is the glass half full. Why was the quarter not as good as it was supposed to be view? Glass half empty is not Amazon's coming knocking, dun. Like, yeah.
Do we have 5 minutes to talk about SBET and BMNR?
Sure. I just have nothing intelligent to provide, but I'm sure you guys do.
Well,
I got nothing. I got nothing.
I am curious. You don't have to enjoy. You have something here. I mean, if you look at Ethereum like a technology, you would suggest that technology is being used more, or large banks and institutions are starting to talk about integrating stable coins or tokenizing assets to some degree. Would you agree, Brad?
Sure.
But why do you take this stance in cryptocurrency? I feel like because it's cryptocurrency, you don't want to talk about it.
I don't give a hoot about buying, selling, transacting crypto. I don't find that to be anything more than greater fool theory, where that greater fool theory is run for a very long time, and it can keep running, and Bitcoin can keep doubling and quadrupling. But there's no. I'm not talking about. I'm not talking about. Okay, right. And so,
Ethereum is very different.
I was probably too short with your response because I was looking at GIFs to respond to somebody on an X post. So I'm just outing myself a little bit. But blockchain tokenization, making transactions higher uptime, faster, cheaper. That is where blockchain needs to go to provide real value, and it seems like that's where it's going. So I guess you can make the argument if whoever's the cryptocurrency rail or whatever, for
so Ethereum is not the best chain. It is not. But every single large company that's going on under their layer 2s, I don't fully understand it. Ethereum is underlying it at this point, at least. I could be wrong. Tanner, there's definitely going to be exceptions to it. Base is
I was going to say
Ethereum,
SoFi
right?
ended up for some reason choosing Bitcoin to end up handling their payment infrastructure.
Actually,
swear
that's pretty dumb. That's like the last one you would go with. If you would have told me
they're doing it with Lightspark, which uses the Lightning Network, so it'll be instant. It's just different because there's not a lot of network effects. But yeah.
But if you like everyone, all these really deep into crypto people will tell you why Ethereum, why this other chain that does or whatever it is similar to Ethereum is better. But for some reason, Ethereum's been here. A hoot. But yeah,
Brad hit us with the hoot.
Stable coins. It costs more money for me to send money to Tanner for no reason other than there's a line drawn on the map. That seems a little weird.
You sound like a hooligan right now, Evan. You sound like
I really don't
get out of here.
No, there seems to be people who thought crypto would launch this entire new industries with a bunch of different companies, crypto native, and maybe there will be some of them, but that doesn't really seem like, I don't think that's what's going to be happening here. What I kind of see is happening, and Tanner was kind of talking about it, we've been seeing Wall Street talk about it a lot, is these existing companies, fintech, banks, everything, are going to use the underlying tech to make themselves marginally more profitable and more efficient. And, there's a couple factors that are coming up for these fintech, and crypto and AI is another one of them. But it's going to be used by these companies, and the coin that ends up winning the most in that, or I don't know what the right terminology is Ethereum, or whatever Ethereum-like coin, because like everyone starts to centralize around. It seems like it's going down the Ethereum route.
Yeah, I wouldn't say coin. Coin's how you cut it, but it's really the blockchain that is. Yeah. Brad, I'm surprised that you don't like, because if you look at it like a technology company, you would say that the utilization is going up. You would say that to some degree they have a buyback program, a dividend. It's very secure. There's not too many competitors, and the regulation is sort of, they're laying down the red carpet in order for this to expand.
I just don't want to bet on I don't want to bet on a company that is reliant on 1 or 2 or 3 cryptocurrencies being picked and doing well. I'd rather bet on the companies that I view as being high probability participants in the rail, like a SoFi or like a Robinhood or something.
Yeah, but those companies are being picked amongst hundreds as well.
Those companies are being
like a customer that's going to the App Store to find their next bank is choosing amongst hundreds of fintechs. So the same way that you are choosing to pick a Salesforce or a Monday or a Workday or a Palantir, people are choosing between Solana, Ethereum.
With a 4% yield doesn't lose all of its value because someone or because next year there's a crypto winter and these asset valuations get cut by it.
Yeah, but crypto winter is going to go away. That is
whenever there. No, it's not. It's a speculative asset class. There is no chance in hell crypto winter goes. That's like saying credit cycles will go away. There's no way.
Well, that's fair, but I think the more utilization that we actually have on these coins, the less speculation on their price that we actually see.
That's right. Fair. So you're saying mainstream adoption makes the peaks and valleys, the peaks lower and the valleys higher.
Bitcoin used to drop by 90%. Last drop, I think, was 40-something%, and I bet the next one will be 30%.
I won't lie. I might be a bad person. Part of me does hope Sailor's takeout price does get taken out, but I am sorry. So I wouldn't be totally upset.
Yeah, I just think,
but I don't think it's going to happen.
If something happens in the crypto space where now this token is going to be the new rail that everyone's focused on, like the financial services companies providing actual products behind the tokenization of secured loans, access to private equity like Robinhood teased at their event, that's still valuable. That's why I'm more comfortable gaining exposure from them than we have a heavy reliance on this being the token that continues gaining lots and lots and lots of adoption. And if it doesn't, then our products can be less relevant and less heavily trafficked. So that's really where I'm at. maybe these companies can hedge with 7 or 8 other meme coins or whatever the hell.
I think you're being too picky,
One
man.
thing to
Like,
say
think about it
also,
that's
think
fair.
about it
Circle built
like
on.
Tanner, a lot of people would agree with you for sure.
No. But like you're either picking between Nvidia or AMD, or you could just pick TSM. But you could pick between the different models that end up winning. Maybe OpenAI wins. Maybe like there's always a fork in the road where there's going to be winners and losers.
There's just so much speculation in crypto for picking the future winners than there is for.
There's a lot of speculation in which model's going to win. But you're a smart enough investor to monitor that.
I don't think there is much I think Google is going to be the bona fide leader for a very long time, and I don't think there's much.
Wow, breaking news.
I have that confidence in saying that about Ethereum because you're seeing the adoption.
Okay. Well, then it sounds like it's a great investment for you, and not
you could do that. You could do that. You know.
Yeah, you're probably right. But I don't know. I like companies and cash flows and top line growth, and that not being tied to whatever this community of people decides this.
But there is all of that on Ethereum. There is top line growth in Ethereum. There's gas. Like it is a company.
What's the current valuation of Ethereum, and how much revenue is the Ethereum blockchain doing in a given year?
That's perfectly fine. I get that. But if you're saying like, into the future, you don't think that all payments will be on blockchain, I would be surprised. Like, I mean, it is going in that direction. I don't know what chain it's going to be on, but
I can gain exposure to that by investing in the financial services companies that will provide the foundation and provide the processes for those transactions happening without being. I can expose myself to that modernization through a lot of the companies we talk about in this chat without doing so through the route that you're taking. Like that's and for me that's just a little more comfortable.
Yep. It's just I think it's another one of those forks in the.
Yeah, sorry, go ahead.
No, I was just gonna say, I think it's just another one of those decisions. Like obviously, you can pick the winners in the fintech. I think similarly, I'm just repeating myself, but I don't think that it's necessarily a different space all that much.
I'm in the minority. Like, look at the comment section. I mean, most people agree with you. So I think mine's somewhat I think my opinion is becoming increasingly controversial, and yours is becoming less controversial for sure.
No, I don't think that playing it through the established rails is not the worst way to go in and do it.
I'm doing that as well.
But I think that it is quite clear that the blockchain tech is something, and I've been saying this for a while, and I've gone too dangerously close to some crypto circles. Like, I don't think this crypto thing is going to be a whole nother industry of companies where it's like crypto natives things. Like, no, there's good tech here that all these major established companies are going to use and become more efficient. So there is, and if you have a tech that gives underlying 10% efficiency gains across the board, that's like AI level excitement with that possibility there. That's quite the large area. So yeah, I get it. I think that there's a big opportunity on probably a couple of those chains. Like Circle's $30 billion company. I don't get that, but I do get that it is built on Ethereum base, and it said some other chain, Solana or whatever. So I don't know.
Yeah, if you say that Ethereum is overpriced, then that makes sense. But you could still run a valuation on what you think Ethereum looks like. I don't like a Bitcoin. I have a harder time because that is, I understand the ideas of greater fool theory there because it's like buying gold or something with less use cases. But Ethereum is a little bit more like a technology company, I would say.
That's fair. And I honestly, I don't think crypto is as speculative as quantum computing is right now anymore. I think it's a little bit, it's not mainstream, but it's becoming more, it's more widely, it's a more widely held view that crypto will create monetary value in the next 10 years than quantum computing. Like who knows when that's actually going to be commercialized. And to me, it's like, okay, do I buy IonQ at 200 times sales where maybe they'll have positive EBITDA in 10 years and maybe they'll have a size, maybe they'll be at 20 times sales right now at this price in 5 or 6 years? Or do I buy Google and make sure that maybe I don't have nearly as much upside if this technology pans out and goes really well? But if quantum computing takes 20 more years than it's supposed to, that's going to be an irrelevant part of the investment case. I'm not even going to notice that on the return profile. So I do think that this is a super important point to just kind of like, the theme of this conversation is differing risk tolerances and differing levels of comfort with asset classes. And I think that's such an inevitable part of markets that I don't know. It's funny that I mean, yeah, it's just interesting. Differing opinions make markets. Say it all the time. So, Tanner, I hope you make a lot of money on your Ethereum bets, and I apologize if I've been rude.
No.
No.
I think that this
I don't
is
think
entertaining for people.
I haven't been rude. It's been entirely professional, but
yeah. If anything, it's a 2-on-1 against you. So
I know, but also I'm from Michigan, so it's sort of close to Canada.
Michigan
So
sucks.
I do apologize a lot. So it's just in my DNA.
Yeah, it bleeds through, eh?
It does. You guys, I mean, I'm a 20-minute drive from my house to Canada, so I feel like we're neighbors for sure. We are neighbors.
Yeah.
I feel very close to you, Tanner. That's what I want.
Yeah. Now it's getting sweet.
Someone said
All
go
right.
blue section. Go, hell yes, go blue. Go blue.
Terrible chat. Tanner, I want to ask you though. We talked only about Ethereum there. You have any BMNR or SBET thoughts?
Well, I think, like anything, if you believe that the asset's going to go up, what I never understand about the Ethereum bets and everything, why isn't there a Palantir treasury? Like, doesn't that work the same way?
S&P 500 treasury. Yeah.
Yeah.
I don't know why we
you're
haven't done
going
that.
out, you're buying an asset that you think will climb up and that's worth more than the equity that you're holding. And then you go out and sell equity and buy an asset that you think is more valuable than the equity that you have. And like, but I do play small bets on SBET and BMNR. I've not done well in them, and learning about this space. But guys, this is such an unbelievably small percentage of my portfolio. I actually hold much more Ethereum than I do SBET. But yeah, I do believe.
Have they been using debt to get Ethereum, or has it just also been?
I think it's a bit of both. I think they're
I hear SBET. I cannot not hear Simplebet, like the B2B gaming software company. I just always we're not talking about SBET right now. Are we talking about a crypto exchange?
Yeah, it's a Ethereum treasury.
Sharplink Gaming.
Is that like BNMR or BNMR?
Yeah.
It's called? Okay.
Yeah.
5 employees.
I think I do like the strategy of BMNR to not put debt on it over maybe I need to just understand more, but yeah, that was one of the things that I did like a lot about BMNR, that they're not going the debt route, they're just going the dilution route.
And I mean, Tom Lee is like that's Tom Lee's, right?
Yeah.
He's basically Elon. Like he's such a good, I don't want to say cheerleader because it sounds demeaning, but he's such a good
dude. I started a Tom Lee tracker account and like within a week it got up to like 10K followers. That was insane.
He is this cycle's Kathy Wood. I'm not saying what's going to happen to him
the virality
in 2022, but in terms of like level of popularity and how much people love him right now, it seems like Kathy in 2021.
Yeah. Whenever I'm explaining who Tom Lee is to anyone that's not in the space, I always bring up Kathy Wood, and people go, "Oh, okay, I know Kathy."
Yeah.
I'm like, "Yeah, well,
you'll know Tom. You'll definitely know him. He's absolutely killed it for the last couple of years for sure."
Guys, I think this has been our longest episode.
Yeah.
I enjoyed it. A lot going on.
Yeah.
It makes sense. We also missed a couple in there. Craziness of earnings season kind of happens, but this is something we're doing pretty consistently. And if you guys hate it, let us know. Maybe separately when we're not all together. If you love it, you can let us know here. But I enjoy it. I want to keep doing it. So I hope you guys are all doing it. Subscribe to wherever you're watching, liking, I don't know, X. But yeah, I enjoy this. I appreciate you guys.
Subscribe for more pitching of ETH to Brad. We'll get him one day.
Don't just subscribe. Go in and hit that bell button as well. Turn on notifications.
Honestly, if there was a crypto winter, and I'm not saying there's going to be, I could see myself using Bitcoin as a hedge against being wrong about the space.
I see that. I would have not expected you to say Bitcoin there.
I would. For me, the finite supply is the most. I think that's a very appealing point of that coin when you have governments just no end in sight to printing and printing and printing. So that is the one that I would put a small portion of. If people gave up on it, I would probably have a very small hedge there, just to make sure that if I am an idiot here, that's entirely okay.
We good to go?
Yeah, on that note.
Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. Make sure you're following everyone on X, YouTube, different platforms. But bye for now.